Yes.
Okay. Hi everyone. Good evening. Hope you guys are doing well, and welcome to the session. Before I begin the session, I would like to make some ground rules. Ground rules are like not to open your video or audio so that we can have a smooth session. And if you have got any questions in between, you can put it in the chat box. I'll pick up all the questions from there and stay here till the end of the session so that you can understand the topic fully and ask any questions during the process. And I would love people to keep your actual name on the like your device where you are joining from so that I can address accordingly. Okay, without a delay, let's get started. So this time, I wanted to do it in a different way. Every time, like it's like kind of theory we are discussing, and we do not understand the like complete flow of the fund, like where it begins and where it goes. So in today's class and this session, I would make an attempt that we'll see how the fund starts and what are the different phases it goes through, taking very simple example and how the NAV is calculated and how the distribution process can happen. So, as most of you are aware about me, my name is Sami Owais, and it's been like more than 16 years. I've been into the fund accounting industry, having worked for mutual funds, hedge funds, some part of the hedge funds, and predominantly I worked for the um, private equity fund accounting. That's my domain, and that's what like to be in and create content about the private equity fund accounting mostly. Right. Okay, let me change the settings since people are not listening. Okay, okay. I'll change the settings so that everybody would be muted. So, okay, today's topic is we are going to see how a new fund, which is like 100 million worth, how it behaves and where it starts and how we do the accounting. Okay, let's begin without a delay. So first thing first is this is going to be like a practical thing, practical scenario we are going to take. And you guys understand the difference between the investment firm company and versus the fund administrators. Example of the fund administrators are like Apex, Citco, State Street, IQQ, Altadomus, BNY, BNP. All these are the examples of the fund administrators. Wherein the examples for the investment managers or investment firms are like Blackstone, BlackRock, EQT. These are the like big names who are the like owner Oaktree. They are the big names in the fund accounting industry, wherein investment industry rather, they are the people or they are the firms which start the funds, create the funds into the market, and uh, go ahead from there. And in our example, we are taking example of someone or you are joining a private equity fund administrator company, fund administration company, right? And you have got a new client wherein they have got the commitment of 100 million. Let's see what all the details we have with this fund. So as a fund team member or the responsible person, you have to do all these things. You have to take care of the 100 million commitment. Basically you need to manage the fund size of your fund size which you are going to handle, that is totally 100 million. So you need to take care of certain things as a fund accountant. The responsibility, you are responsible for creating the capital call calculation, doing the capital call, booking the entries into the system, and you also responsible for booking the investment related entries, because when the GP calls money from the LPs, then it is understood that he is going to invest somewhere. So there comes the investment part where you where the fund like make the investment, and so as a fund accountant you are responsible for booking those investment entries as well. And every fund would have certain good number of expenses. Can you guys just type in quickly what are the other expenses than the management fees? Just type in quickly, couple of them. Expenses, very specific, write it very specific. Audit fees, transaction cost, okay, legal fees, admin fees, tax fees. Very good, very good. Thank you. So these are the all expenses we have, wherein the fund or the fund accountant has to take care of that. Can you guys put yourself on mute, please? Okay, then moving forward, we have investment income also, because nowadays we are listening about a lot of about the uh, private credit funds. So if you're investing into such funds, for such investments, then definitely you will receive some recurring incomes, right? If you're investing into some DDTLs, ABS, asset-backed securities, or the term loans or liens, there are different variety of like instrument. If you're investing into them, then you will receive some monthly interest or the quarterly interest. So as a fund accountant, you would book those all investment incomes as well. And very important part, the big source of any uh, fund's income is the realization of the investments, because you take the money, GP takes the money from the LPs and make the investment somewhere, and whatever the returns he will get it from the those investments, then he will get back it to the fund and make sure that he will distribute it to the LPs. So investment, doing the investment valuation is very core thing, where we test the skills of the GP, like if GP is really performing well or not. So in keeping an eye on the investment is very important. So the moment you receive some distributions or the sales proceeds from the investments, you will do the lot of distributions to the LPs. We'll see that, and we'll see how the distribution would impact the LP capital accounts at the end of the day, because all these transactions, all these entries what we are discussing, whether it is a capital call, whether it is a distribution, booking the investment management fees, or any other expenses, everything is going to affect my NAV and the LP capital accounts, right? And once your NAV pack is done, then the financial reporting comes into picture, where you prepare the balance sheet and other stuff. Okay, all right. So this is one hypothetical or the fictional fund we will take example of. It is, the fund name is ABC Growth One Fund. Total fund size, the total commitment we have got for this fund is 100 million, and number of LPs we have 10, and the growth strategy is a growth capital. You know, there are a lot of strategies like how the fund invest is, that's what we call it as a strategy. Can you guys stop scribbling on the screen, please? I don't know. I should have changed the settings. Remove that, please, if you can. Oh, okay. So fund term is like 10 years, because this is a close-ended fund and they will have a always have terms, and the management fees is 2%, carried interest is usual 20%, preferred return. These are the all the standard percentage you must have seen. 2% management fees, carried interest 20, and the preferred return, which is the minimum rate of return, which is 8%. Okay, initial investment means where this fund want to make the investment for. So total amount what a fund this fund can collect is 100 million, and out of that they will the GP would do some capital calls, and he wants to make investment of 15 million at this point of time. Maybe later he will do more of the investment, but at this point of time his intention is to make investment into one company worth of 15 million only. And couple of things to keep in mind. This fund, it's very standalone fund we are talking about, wherein LPs are there who are providing capital to the fund, and then we have the GP who is managing the fund, and fund administrators basically responsible for taking care of the accounting books and the reporting stuff. Okay. So to make the thing simple, I kept had taken the example of like 10 million. Each one is committing 10 million of the commitment, making it to the total fund size of 100 million commitment. And you guys would be knowing, right? Like GP is responsible for making all the decisions of the fund. So ABC Growth Fund is would be managed by this particular GP. And GP is responsible for taking all the decisions. Basically, LPs won't be responsible. LPs just be passive investors, and they give money and be in the fund. And at the end of the day, all responsibility lies with the fund accountants, where they sit in between and ensure that how each dollar is coming into the fund and passing through the different stages and reaching out and getting back distribution to the LPs. So one thing incorrect, everything becomes like subsequent events would be like kind of incorrect. All right. So this is a list of the how like 100 million is spread among the like LPs, right? So these are the like LPAs committing 20 million, B 15, and so on. The first question I want to ask you guys: when I say commitment, do I mean the cash? Am I really the cash? Really receiving the cash? The answer is
No.
no,
No.
right? Because commitment is just a commitment. It's a kind of promise which the LPs are giving to the fund that they would pay some certain sum of amount whenever they are being asked. So no cash would be involved. In the interviews, usually we ask the candidates, what is the entry for the commitment? And all of a sudden, out of the excitement, they would tell us the like capital commitment, something entry. For your information, there is no entry would be there for the commitment. Okay, when the capital call happens, then only you will have the actual entry coming into the place, actual cash movement happens. So in the at that point of like commitment, no entry would be made. It is just a commitment, is it is just a promise. All right, any questions? Okay. So what they do before, okay, who is that man? People. So whenever GP wants to make a capital call, he will make sure that he has to know what he is calling for. He should know the reasons. He should know the components of that. So in this case, our GP has identified one investment opportunity, because he should be mentioning it to the LP. What is the cause of doing that, right? Why he is calling that capital, right? So in this case, he would require 15 million. So what he does, he will make sure that he will issue a capital call for that. And for that, he will create the notice. He will make the he means, just referring to GP as a he, but it can be one entity or the one company itself. And who will prepare at the end of the day? We prepare. We as a fund accountant has to prepare that. GP will just approve that if they are taking the fund administration services, right? And assumptions, couple of assumptions we always need to keep before making this decision. So in this case, 15 million is the requirement for making the investment. Assume that our fund, what was the commitment, total commitment we had? You can put it in the chat, maybe. What is our total commitment? 100 million. Everybody agrees, right? 100 million. Good. Thank you. So 100 million is our commitment, but do we call, or does the GP call 100% of the amount? Usually that doesn't happen. They call into some small pieces as per the requirement, right? What is the requirement? He will call that much only. Why should he call and keep it ideal money into the books, right? So in this case, his requirement is 15 million. Then why he is calling 20 million? Right? The requirement is 15 million he has to invest. Any guesses why he is calling more money? Why he's calling 20 million? He should have called only 15 million.
Because for fund expenses and other related expenses.
Any other expenses, any other buffer, he wants to keep it within the fund, right? Some buffer he wants to keep so that he can pay some expenses. The moment the fund starts, then the expenses also starts, right? He has to pay management fees to GP itself, right? GP will start, and if you're taking admin services, the administrator would ask for the fees, and for that matter, any fees, whether it's a legal, professional, any kind of fees. Okay. So in this case, requirement is 15, but the GP is calling 20 million. Okay, GP is calling 20 million. And how he has done the bifurcation? It is also clearly visible here. For the investment, 15 million and 500K for the fund expenses, and 4.5 million he wants to keep it for the future requirement, because there are certain expenses which are recurring in nature, like management fees, admin fees, audit fees, tax fees. These are the couple of fees which are like very recurring in nature, right? So keeping in mind all that calculation, GP has done the capital call of 20 million. Then what do we do? GP will tell you how much to be called, but you as a fund accountant, we as a fund accountant are responsible to calculate how much each LP has to contribute. Because looking at the lump sum amount, we can't say, okay, you pay something, you pay something. No, you have to define that moment. You have to do that calculation. Okay. And make sure that you are when you call from each of the LP, you are calling the accurate amount rather than just calling some amount. Okay. In this, we are taking example of one LP, wherein we'll see how these LPs go about. There's an LP A who has a commitment of 20 million, right? Big LP, giving like almost 1/5 of the total commitment. So assumption is, again, we are doing a 20% capital call. So how much he will pay? 20 million is his total commitment, and the capital call what the GP is calling is a 20%. So 20% of 20 million is a 4 million. Simply, in simple words, LPA will get 4 million into the fund. And how much still he has to give? His commitment was 20. 4 million he has already funded, and his unfunded is 16 million. We call it as a unfunded commitment, meaning unfunded is such amount which is the fund still can call at any point of time. Okay, let's see the journal entries also, right? And assume that everybody is, I am sure on the call, people are there, everybody is aware of the journal entries, cash journal entries we most of us are aware of, but where we struggle is the accrual journal entries. And I prefer, like, if somebody wants to be a good fund accountant, then definitely you should be knowing the accrual entries well. Cash anybody can understand, because that would be easier thing to know about. Okay, so when we are booking the journal entry, what we do, we assume that we are not receiving the cash today itself, but we are booking this entry as an accrual entry. So what is the entry we book for the capital call? We book for the this entry, like contribution receivable. We'll debit that, because that would become an asset for us, the amount we are expecting from the LPs. And always remember, whenever you do the books, do it from the funds perspective, not from the LPs perspective. So the answer is contribution receivable, right, to partners capital. Partners capital or partners contribution, whatever you want to call it as. Different system use different names, so but the underlying logic would be same. And when the actual cash is received by the fund, always remember, guys, this point where a lot of people I have seen get confused. The point here is, whenever you are writing the books and whenever you are the fund accountant, write it from the perspective of the fund, not from the perspective of the LP. You are not LP, you are not GP, you are the fund. That's why we are called as a fund accountants. Okay, so that will not keep you confused also, because in this case, when I am saying cash is received, But LP perspective, LP is giving cash, right? So always be clear and keep in mind you are the fund. So when the actual cash is received, what you do, you will debit the cash. The simple logic I don't have to explain you because everybody is aware of. So cash is debited and the receivable you created that would get credited. And ultimately, if you look at the entry, that entry will become like this: your cash versus cash account debit, and partners capital contribution would sit on the credit side. So what a fund accountant is doing, fund accountant is tracking the commitment first, like how much each LP has given, and he is making sure the capital call is being calculated like very accurately for each of the LP. You cannot make the mistakes here. Okay, you don't have that bandwidth to make the mistakes. You are you, because your single mistake in the Excel can make the all notices incorrect. So you have to make sure that you are processing it well and doing the calculation for the funded portion and calculating the unfunded portion as well. As unfunded, why unfunded is important? Because unfunded is the amount which the GP will keep an eye, thinking that this is the amount I can still call back from the LPs at any given point of time. Okay, now the amount is received. Next thing what the GP does is GP will make the investment, right? GP will make the investment. In the our example, XYZ Technologies is the company where GP wants to invest that 15 million. And what is the entry we book for that? Simple entry. Whenever we make the investment account to cash account. Investment being the asset would get debited and cash is going out, cash will go out. And once this entry is booked, and if you pull the like trial balance or any other statements or the reports from the system, you will see that 5 million is sitting in the book and 15 million you are showing as an investment, right? One capital call happened, one investment happened so far. Are you guys with me? Able to understand so far? Put it in the chat, please, and confirm your understanding if you guys are good. Okay, thank you. Okay, next thing. So this is not the end. Okay, this is just a beginning. This is just a beginning, I would say. Because once you make the investment, it's not like you will wait for the selling it. Today you invested and after 3 years I want to sell because being into the private equity industry, I know it. I have to keep the long-term perspective, and I will wait 3 years. Till then, nothing is going to happen. Do you think that is going to happen? But in reality, things would be different, and we work very practically as fund accountants. So what we do every point of time, whenever we want to do the NAV, right? Whether your NAV is monthly, whether your NAV is quarterly, we have to do something called as valuation, right? Valuation is very important. And for your information, most of the private equity funds would calculate NAVs quarterly. They have to do the valuation, right? So valuation is nothing but the checking the value of your investment. For example, in our case, we invested, we means now we are the fund, okay? So we invested 15 million, and you will check before you calculate the NAV, do the NAV process, you would check what is the worth of that 15 million today, right? And you will, for that you will use some techniques, some calculation you do, because that's a private company. Valuations is not easy to ascertain in private companies cases because they are not traded, right? So in our case 15 million worth of investment we have done, but when we reached out to them and asked them what is the worth of my investment today, they confirmed that the worth of your investment of 15 million is 18 million today. Right? What happened? Your value has increased, meaning your investment is performing well. You invested 15 and current value is 18. And the difference, I'm sure most of us already know about, that is called as unrealized gain, right? So this unrealized gain plays very important role in all the NAVs. Whether you are talking about the NAV of private equity, hedge funds, or the mutual fund, this unrealized gain part plays an important role. On the other hand, there is a possibility that there can be some losses also, that we can call it as an unrealized loss. In that case, my NAV would get decrease, right? Possible. Okay, let's see what else is happening. Okay, so if you go to the like balance sheet, right, at this point of time, if you go to the balance sheet and you will see. So what do you think the investment value would be showing us, whether it's going to be 15 or 18? What do you guys think?
18.
15.
Okay, okay. Put it in the chat, please. So I'll see how many people say 15 and how many say 18. Okay. So some 15, majority 18. Okay. As a general rule, uh, as per the like US GAAP, and if you are following the IFRS also, they have certain things, certain what you call rules as per those standards, right? As per those standards, we have to always show the fair market value, right? Fair market value, which is in this case it is the 18 million. Why do I have to do that? Because your cost is different and your current value today is something different, right? So in that case you need to show the fair market value. Why I'm calling it as a fair market value, not market value? And the reason for that is what the number you have calculated 18 is the not the actual or exact number. Exact number, when you can say exact number? Exact number you can only say when something is being traded in the live market. This is not the live market. This is the passive market you are talking about. You are talking about a private company in some other country. Just a small kind kind of company, right? Wherein we have made the investments and using some techniques, using some formulas, we have like calculated and arrived to this number of 18 million. And of course, if the value increases, it gives you unrealized gain, and the value decreases, of course, you will have the unrealized loss in place. Okay, how do we record that? Even though you are not selling your investments, but you are interested to have this increased value into the system so that you have a good NAV, right? So even though we are not selling, but we are still increase the value of the investment. That's a benefit of having the unrealized gain into like into the systems, right? And this is as I mentioned previously also, this is the actual source of income for the fund, getting something from the investment. In this case, even if you are not getting something from the fund, still you are calculating the unrealized value, taking the like again fair assumptions and doing some estimations. That's the reason your investment value gets increased, and it will we will record the entry as the investment value investments against the unrealized gain. Unrealized gain, whenever it is a gain, and it will get credited and write on the we will write on the credit side. So overall, if you go and see the balance sheet now or the schedule of investment, you will see that 18 million would be appearing, not the 15 million, because as per the rules, general rules, industry standards, we always have to show and reflect the 18 million, not the 15 million. All right. Okay. So once we are done with this, then we will move on to record the expenses, because no fund will run without the expenses. Whether again you talk about mutual fund, hedge fund, and the private equity funds, expenses are the integral part of any fund, and there would be lot of expenses in each of the fund. And who will bear that? Will the GP bear or the fund has to bear? What do you guys think? Put it in the chat, please. Will the GP will take care or the fund has to bear? All agree, right? Fund. And ultimately, when we say fund, it is that the LP who is bearing ultimately, right? Ultimately, it will affect the LP's cost. Whatever he has invested from that, this would be get deducted. So total expenses, after doing the calculation, we can see that total expenses are 500,000. And always one thing, if somebody has not worked into this domain, start speaking numbers in millions, because in all the companies, if you're working for international companies, then we talk about the numbers in millions. So get habituated of this. Okay. Expenses again, if you are making the only accruals, and that's what happened at the initial stage of the funds where the payment happened at later point of time, then your expense entry would be uh, for example, like management fees. If you are booking, then it would be management fees to management fees payable. And the question here is why LP not GP? Because it is LP's fund, it is LP's contribution. GP is responsible for managing the fund. GP is not taken the responsibility of bearing the expense. GP has taken the contributions from the LPs, and he's serving. In other words, he is serving that, and for serving the fund or taking care of the operations, he is charging some fees also, management fees. Then how can he and why he should pay the extra fees? He's saying, I am giving you some service, pay me management fees, and if I outperform your benchmark, then give me the performance fees, which we call it as a carry. Okay. Will GP do any capital contribution? Possible. Some like 5 to 1 to like 5%, they can like invest into. And the reason is they want to have some trust from the LP side. So minimal investment they will make it to get the LP's confidence. Yeah, rightly said. Okay, coming back to our example. So the entry would be fund expenses to fund expense payable. Or if I have to ask you about the audit fees you are booking, then you will book the fees as audit fees to audit fees expenses, or audit fees payable. Sorry, audit fees expense to audit fees payable. Okay, what do you guys think? This 500 of the expenses will affect the NAV?
Yes.
Because your NAV calculation is assets minus liabilities. Then how this will affect?
Because it's an P&L item.
Okay, liability is increasing. Very good, very good. Because when I'm finding the approach of assets minus liabilities, then my liability is increasing.
Yeah.
If from the cash perspective I'm saying my cash is decreasing, right?
No,
Very
there
good.
is no
Yes,
impact
versus a
on
payable.
cash.
Yeah. No, in case payable I'm talking about. Somebody mentioned about. So there is a two
Yes.
possibilities here in this entry. One is you are creating the payable, and another possibility is you are paying the cash. So if you are going with the cash, then cash is impacting. Going with the payable, then it is impacting your liability. Okay, very good,
It's
and
liability
thanks.
increasing or cash decreasing? Yeah.
Yep. Okay. Okay, let's take a moment here and calculate the NAV. That's what we want to arrive at. I'll take that question. Okay, somebody put a question. So, what is the usual formula we say for the NAV? We say assets minus liabilities. So, what are all assets we have? We have some assets sitting into our books, which is 4.5 cash, which is 4.5 million. How? Do you guys remember how it has become 4.5 million? Because we called how much?
20
million.
million.
So can someone put it in the chat how the 20 million has become 4.5 million now? Just put it in the chat, no prompt, so that everybody get opportunity. No numbers. I need the numbers. Okay. So how 20 million cash has turned into be 4.5 million now? Okay, let me see. I'm trying to pick up the right answer. The right answer is 20 million cash, 50 million gone for the investment, 500,000, which is 5 lakhs, has gone for the expenses. Okay, good. I hope all agree. Yeah, I think everybody is on the same page. 500 okay, good. All are on same page. And the investment value, we are not taking the actual cost. We are taking the fair value. Remember that and look at this in our table. Next component of our NAV formula is the liabilities. And assuming, because expenses we assumed here to be paid, and assume that there is another liability which is again worth 500,000, right? So what is my NAV? My NAV is very simple. I'll take the total of my assets, which is mentioned here, 22.5 million, and I will take out my expenses out of that, basically the liabilities. Then your NAV arrives. So asset minus liabilities, asset total is 22.5 million, liabilities total is 500,000, and the net figure is 22 million. Somebody is asking, explain about the 4 million. Yeah, I think Teja has put that. So 20 million you called, 50 million you gave to the investment, 0.5 million you paid for the expenses, and you're left with 4.5 million. And what is your NAV? Your NAV is 22 million. Very simple calculation. Okay. Okay. This I think we have discussed, right? 3 million. Where is 3 million hiding and how it is has impacted? 3 million is what the change, it has brought the change to the fund. Do you guys agree? Because of that change in the investment value, your NAV also has changed, or you have a good NAV, positive NAV. Okay, what is the NAV? If assume that if I'm booking at the cost, what is the NAV? Tell me the value. Yeah, somebody tried already. Oh, two answers. Three different answers. So 19 is the what I see majority. And somebody can put it how you got the 19? Or 22 people who are putting 22, you can also put your answer there. And my point is, if you are putting the investment at cost, put the calculation please, asset minus liability. Put the whole calculation. 19 less 4.5 is a cash. Okay. So simple thing you need to keep in mind is your look at your investment. Investment I mentioned it is a 15 million, your original cost, right? Yes, you should not consider unrealized at all. Then in that case 15 million plus 4.5, how much? 19.5. 19.5 minus 0.5. Answer is 19. No, I think people have not got the question. My point is, what if my investment stays at the cost? So investment value stays at cost only, which is 15 million, and add 4.5 million cash, which is 19.5 million, right? This is your assets, 19.5 million. And what are your liabilities? 0.5 million, right? And of course, your NAV would be 19 million. So those who answered 22 or 24, whatever, just look at your answer and change it accordingly, or change the assumptions. Maybe you are assuming fair value here. Okay, all right. Okay, coming back and see what the fund accountant's work is to be in this situation, what all the fund accountant would do. We are, as a fund accountant, responsible for doing the cash investment and partner reporting, partners capital, and the reporting part. Within that, under the cash, we do the bank rec, meaning we ensure that each transaction hitting in my books, I will make sure that I will booking that properly. Any capital contribution distribution is happening, I'll make sure that I'm booking it into the system. And any purchases, sales happening, or any such thing happening, I would book that, and any expense payment happening. On the investment side, I have the investment activity, purchase and sales, right? Adjusting my cost in case of something is like going wrong, or I'm not expecting any amount from that particular investment, then I do the write off. Then fair value, looking at the fair value, I have to book the unrealized gain and loss. And if I'm selling that, I can get the realized income or realized loss. Under the partner statement, I have to take care of all the contributions, distributions, allocation. Allocation is very important, because not what do you guys think? Expenses, how I bifurcate my expenses into a fund? How I divide that among all the LPs?
Based upon commitment.
Put it in the chat, please. Okay, some says contribution, some says LPA, some says commitment. Okay, simple answer to that question is based on the commitment. Okay, whatever the commitment you give, then that becomes your thing. But disclaimer to that is, you will have certain expenses which are not calculated on the commitment, like management fees. Management fees can be different. Different LPs can pay different management fees. Assume that there are two LPs having the same commitment, but there is a possibility that both of them are paying different set of management fees. Possible. In that case, you will not use commitment, rather you will use LP specific commitment. Okay. Then ultimately we will calculate the NAV, right? Because fund accountants, at the end of the day, we are responsible for calculating the NAV. And once NAV is approved, we go for the financial statements and the investor statements, which are nothing but the capital statements. We call it as a PCAPs. Okay. Assume that after 3 years, the investment we made is sold for 30 million, right? Then what would happen? You invested how much? 15 million, and you were so far booking all the unrealized gain and loss and unrealized gains, because everything was in profit. Now you wanted to sell this. And assume that assumption here, one assumption we have to make, that this particular security we invested 22 million. Okay, 22 million we invested in this particular security. Who is that scribbling? Please avoid. Right. So in that case, if my cost is 22 million, that's the amount I have paid for investing into this particular company. Then in that case, 30 million, if I'm selling that for the 30 million, then 8 million of difference, that is called as realized gain. I hope you guys agree, everyone. Any questions, clarity in this? If you don't sell, you do the valuation, that is your unrealized. When you do the actual sales, that becomes realized gain. As simple as that.
Can you please repeat once again?
Yeah. So when you don't sell any investment, but you do the valuation, that we call it as unrealized gain and loss. On the other hand, if you sell some security or the investment and you get your cash back, two possibilities. Either you will run into the profit or the loss. And that profit and loss is called realized gain or realized loss. 22 million in this case, assumption is this is the cost for this particular investment. Forget about that 15 million. Assume that 20 million is the cost for this particular investment we are talking about. Okay? Maybe like 15 million you invested in the first phase, and 7 million you invested later. So your 22 million is your actual cost. Because for the sake of realized gain, you will seek actual cost value. You don't consider the market value. Okay? The 22 million must be your cost if your realized gain is 8. Okay. How do you record the sales? Investment, you are selling the investment, right? So investment, which is usually your asset, gets credited now because that is going out of the books. And in this case, realized gain is your profits. And as per the golden rule, what is the golden rule for the incomes, recording incomes? Credit all incomes and gains. That is why it is sitting on the credit side, and the cash is coming in on the debit side. And the whole of the investment is converted into the cash. No more investments. So if the cost is 19 million, realizing it would be 11 million. Yes, if the cost, assume the cost is 19 million, then the realized gain would have been 11 million. Yes. Yeah, for LP up to their commitment only, but what about GP? What is your question? You need to give me the clarity, please. Okay, this is how the whole idea like turns into. So let's see what happens next. Okay, once we got the cash back, we in the sense I'm talking about the fund, we invested somewhere and it has given some good returns. We have seen some realized gain coming into the fund and some proceeds also come. Now,
Sir, and
out
also
of
we need to reverse the unrealized gain also, right?
yes, that's there. I don't want to go into the depth given the time. Okay, yeah, that adjustment we have to do. So assume that, see, one thing you need to remember, whatever the amount you're getting, it is not necessary that GP will give you back everything. So in this case, GP has to decide how much he has to give. So he decided that he wanted to give 20 million back to the LPs. Right? Then all these questions have to be answered by the GP. How much he wants to give, who will get that, who in the sense like which LP will get how much as per the calculation, as per the commitment he has to decide. And under the distributions, you guys are aware there are different types, recallable, non-recallable. He has to tell, right, how much is the return of capital, because you take the capital from the LPs and some point of time you have to return that capital. So GP has to decide how much Return of capital he wants to assume out of that distribution, or he want to assume that as a just a income distribution kind of thing. And waterfall, whether the fund has reached to the waterfall or not, all these questions happen at this phase of the fund's life. When the distribution happens, you talk about the waterfall, you talk about the carry and everything. That's the reason all these points you are seeing, that we are talking about the waterfall now. We didn't talk about the waterfall previously, because when you start receiving the proceeds, then only you will talk about the performance fees, because performance fees only come into picture in private equity fund accounting when there is enough cash to pay. Right? So out of this 25 million, assume that LPA owns 20% of the fund, then he will get, how much he will get? 5 million, because 25 million is the total distribution and he owns 20%, then he will get 5 million as a distribution. And what is the entry? Entry is simple again. You can use the same partner's capital which you have used for the writing the capital call entry. You can just use the same thing, but there it was a credit, here you have to debit, or you can use the distribution, the wording as a distribution, and book the entry. Performance fees, carried interest, both are same. Performance fees in private equity, we call it as a carried interest or carry. There is nothing called as performance fees exist in the private equity domain. We call it as a carry or carried interest. And yeah, so distribution, you guys aware of European model is there, American waterfall model is there, and assume that investment proceeds we have received 30 million and the LP contributed 15 million. So total profit sitting in my hands in the fund is 15 million. Now, as per the LPA, you need to read LPA and define how you want to split that, and whether the waterfall will be come into picture or not. Do you have enough cash to give it to the GP as a carried interest or not? Right? So it has a different steps. We call it as a different tiers. You must have seen in a lot of posts. So first thing first, in the European model, what is done is the return of capital happens, then preferred return, which is the minimum rate of return, which is given back to the LPs. Then the catch up amount is calculated and given to the GP. This time, the first time GP will receive something. So then whatever the remains after that, that would be split between LP and GP in the ratio of 80-20, where LP would get 80% and GP would get 20%. So net to net, GP will receive 20% of the total profits. Okay, so what all we have covered so far? We started with the 100 million commitment, if you guys remember. Then we have 20 million of the capital call. Then out of that, we made the investment of 15 million. That investment turned out to be a 18 million as per the valuation. Then we calculated the NAV, and again after this NAV we might have invested some more amount, which made our investment value at 22, and the same investment we sold it for 30 million, and 15 million realized profit. Was it 15 million? Yes. Okay, assume that this is a 15 million realized we have, and utilizing this, because the moment the fund start receiving the amount, it will do the distribution, and once these distributions are done, then capital accounts are updated, meaning the NAV would get changed accordingly. And once the NAV is prepared and done, then financial statements are prepared, then investor reporting, nothing but the issuing of the investor reports, or we call it as PCAPs, partner capital statements, that would be issued. One quick question here to test your knowledge. ABC fund has cash 8 million, investment at fair market value 40 million, receivables 2 million, accrued expense 3, other liabilities 1 million. What is the NAV? A easy one, I believe. Everybody agree it's 46 million?
46. Yeah.
Okay. 57, who is that? It's 46, right? Simple calculation. Right? All assets, take all assets. 8 plus 40. I think I have, no. So 848 plus 250 and all liabilities. So 50 minus 4, it's simply 46. Thanks for somebody has put in detail also. Yeah, this is a simple life cycle of a like the journey from the commitment to the capital call to the investment to the selling of investment, first having the unrealized, then realized, then taking the exit, having the realized gain, and once that realized gain is coming to the fund, then ultimately giving distribution to the LPs. Okay, common mistakes which people do, and that's where the problem comes. Just understanding the journal entries will not help. You need to understand why you are debiting or crediting something. Many people can tell me the formula of NAV, which is asset minus liabilities, but what actually matters? What do you mean by assets? What do you mean by liabilities? What all liabilities you need to take is that you need to understand. And the other way around, other formula, right? What is the other formula of calculating the NAV? Learning the capital call, knowing the basics of that, but don't understand the how it will impact the books, right? And about the valuation technique or doing the valuation entries in different system would be different. You need to understand whether you need to book the direct unrealized entry or booking the fair market value, so that in one system I remember wherein we had to book the valuation amount, then automatically system used to calculate the unrealized gain and loss, and in another system we used to book unrealized entry directly, unrealized gain or loss entry. So we need to understand what entry to book and how it is impacting the system. Waterfall formulas, knowing just 80 20 80 20 8% 9%, that will not be help. You need to understand the underlying logic and what is the period, whether your waterfall model is European American, you need to understand that. Okay, with that I am done. A couple of questions I will take before you guys have asked the questions quickly. Somebody asked who will set up. Yes, investor reporting team will set up the all the static data, all the investor information. Fund accounting team usually don't do. Investor team does that. You call it as onboarding team, you call it as investor reporting team, you can call with the different names. Okay, can GP call money even after final call done from new LPs? Final call, there is nothing called final call. As long as capital is required, GP can keep calling money from the LPs. And once the commitment is done, usually they don't ask for the extra money, right? And the fund gets liquidated. Recordings will be shared. If GP is contributing, then fund expenses is shared as per capital contribution ratio between GP and LP. No, it would be same way. Commitment ratio would be followed if the GP is contributing, right? What source document considered for preparing capital calls? So GP has to provide all the documents, supporting documents for you to prepare the capital calls and the distributions. The GP is responsible for doing that. Okay, this is a course for if somebody is interested. I have two offerings in this. One is like daily batch I have started, which is happening from Monday to Friday, and the timing is morning timing 8 o'clock. If somebody is interested, you can enroll, which is happening starting basically by tomorrow. So Monday to Friday, it goes for the like 3 weeks, and weekend batch as usual is going on. Weekend batch happens on the Saturday and Sundays. 2 hours classes would be there, and it goes close to like 2 months. And what we cover, everything we cover, basically it will start with the fundamentals of the private equity, understanding what is private equity and how it is different from other things, and understanding different fund structures, and important fund document, because this is necessary, guys. Just knowing that some terms are not going to help you, you can't survive in this competitive market. In the coming days, you will see that only people will survive those who are the SMEs of the process. And just working somewhere, not getting the proper exposure will not give you the 100% exposure of the things, right? So just a caution. And we discuss about the journal entries, and one class on the generic journal entries, on one class on the proper private equity fund journal entries, and equalization rebalancing practically with full examples, and the waterfall also. European, we'll see how European and American different to each other, and how it is done and calculated on the Excel, that would be there, and IRR, MOIC, and how these are like calculated. uh, Everything would be covered, and at the end, NAV package is what I will show, and I will show how the financial reporting would be done, and what are the like reports, what how it looks like, everything basically we cover in this. And also I've built one equalization rebalancing tool, so that access will be also given to the people who are opting for the course. And somebody asked fees and all, you can reach out to the number given, shared into the chat, and you can reach out to me also in case you guys are interested. And last question I want to take it, somebody asked, private equity, private credit are same? If you ask me, I would say both are same, just that investments are different, right? If investments, if you are making investment into term loans or other securities where the interest bearing securities, then that strategy is called private credit strategy. But private equity and private credit, you considering both things are different, that is not the right answer. Okay. Weekend classes timing, afternoon it would be 3 o'clock, 3 to kind of 5, and the morning is 8 o'clock to 9:30 kind of. Okay. I hope this was helpful, and I share a lot of content already on the LinkedIn and YouTube. You guys can go through that and make yourself equipped, and try to make your career into like private equity fund accounting, which is in high demand. And I will come up with some more sessions in the future. Till then, thank you and have a good rest of the day.